More and more people in the US are borrowing a lot of money by using their homes as a way to get loans. This is something new and surprising. It's making people wonder about how safe it is for their finances, the housing market, and the economy overall. As this borrowing reaches really high levels, people are starting to ask questions about why this is happening and what could possibly go wrong. In this video, we'll delve into the recent upswing in HELOC loans, shedding light on the factors contributing to this trend. A HELOC, or home equity line of credit, has witnessed a surge in popularity as homeowners increasingly tap into the equity of their homes. This surge owes its momentum not solely to homeowners' financial capacity, but also to the concerted efforts of lenders and media outlets in promoting it. CBS News appears to be advocating for the adoption of HELOC loans to yield profit. To exemplify the magnitude of this phenomenon, statistics from the New York Fed reveal that HELOC balances surged a staggering $3 billion during the initial quarter of 2023. Nationwide, HELOC balances now stand at an impressive $339 billion, a substantial debt burden shared by the average American homeowner. This funding is frequently channeled into home renovations due to prevailing market conditions. CBS News champions this as a judicious choice, notably due to the associated tax advantages. Should HELOC funds be directed towards home advancements, the interest accrued on the loan becomes eligible for tax deductions. However, it is imperative to recognize that certain critical aspects maintain conspicuously unaddressed. It's vital to acknowledge that HELOC loans are anchored to adjustable interest rates, which have recently scaled heights unseen in 22 years due to Federal Reserve interventions. Such elevated interest rates could potentially inflict financial strain. Moreover, the specter of foreclosure looms in the background, a scenario not openly discussed. Surprisingly, even a relatively modest loan sum, say $20,000, might lead to foreclosure if payments falter due to circumstances like job loss or marital dissolution. Another pivotal aspect that warrants attention is the ongoing decline in property values nationwide. Opting for a second mortgage via HELOC could amplify the risk of finding oneself underwater on the primary mortgage, where the owed amount exceeds the property's assessed value. It is prudent to exercise caution when confronted with such information may not invariably be tailored for your benefit, but rather influenced by financial interests. The motivations underpinning these endorsements are not entirely altruistic. Frequently, there is a financial incentive driving them. CBS News is promoting the idea of acquiring a home equity line of credit, HELOC, and presenting it as a highly favorable choice. In contrast, our viewpoint opposes this stance, considering a HELOC to be an imprudent option. Instead, a more judicious decision in the current scenario is to explore certificates of deposits, CDs. It's important to clarify that this isn't an endorsement aimed at endorsing specific banks or offerings. Rather, I've been observing recent CD rates and they appear to be quite appealing. Both Santander Bank and Sallie Mae Bank are offering enticing deals, providing a 5.5% interest rate for your investment. This interest rate holds particular significance given the prevalent inflation and the inherent risks associated with other investment avenues such as stocks and real estate. Holding a CD at this point presents a remarkable opportunity. The allure of earning 5.5% interest with minimum exertion and risk is quite strong. Comparable options like T-bills also offer similar rates, but CDs provide greater flexibility. While T-bills might lack liquidity, CDs permit withdrawals, albeit with potential penalties that could slightly diminish your earnings. Let's consider this scenario. If you possess $100,000 available for a housing payment, placing it within a CD could generate $5,500 in a year, quite a lucrative return with minimal exertion or risk. Shifting focus a bit, the issue of homelessness is indeed present. Although its severity might not be as pronounced as initially anticipated, Los Angeles, for instance, harbors a significant homeless population of approximately 75,000 individuals. However, these numbers are not concentrated to an extreme extent in this particular park. Of note, Realtor.com has made a change in its stance, initially predicting a 6% increase in home prices, but now revising it to forecast a decrease of 0.6%. On the other hand, Morgan Stanley's 2024 projection suggests stable prices throughout 2023, followed by a subsequent 2% drop. Focusing on the extent of the decline and predicting property purchase timing with certainty is unproductive, as accurately identifying market bottoms is only possible in hindsight. Presently, the housing market is displaying the signs of steady as there is a projected decrease in prices on the horizon. This development holds promise for both potential buyers and sellers alike. If you've been hesitant to put your property on the market due to the prevailing high interest rates and soaring prices, the situation is poised to undergo a transformation in the upcoming years. It's noteworthy that numerous real estate firms, financial institutions, and economists are acknowledging the trend of prices, showing a tendency to decline rather than escalate. This phenomenon stems from the current tightly constrained market conditions, leaving little room for further upward price shifts. Factors such as concerns surrounding affordability, the volume of mortgage applications, and completed property sales all contribute to the unsustainable nature of the prevailing market. Consequently, it's improbable that prices will sustain an indefinite increase, given the restricted number of buyers who can realistically afford these properties. The dynamics of the market are also being influenced by mortgage rates, which are currently impacting and will continue to shape market trends. Although an eventual reduction in mortgage rates is anticipated, it's unlikely that they will drop to the desired levels. With prevailing average interest rates hovering around 7.3 to 7.5%, even a decrease to approximately 6.5 or 6.3% remains relatively substantial. Moreover, there's an observable pattern of banks offering fewer mortgage products to the typical buyer, further impacting the landscape of the market. Presently, banks are exercising caution due to their own financial challenges, resulting in stringent loan approval criteria. Borrowers are required to possess a robust credit score, a stable income, a significant down payment, and substantiated evidence of affordability. An exception exists for FHA borrowers with a credit score of 580, although this entails increased risk due to a lower down payment. Differences in interest rates and pricing dynamics create a gap. Selling property is lucrative, but affordable housing is a challenge, particularly for market advancement, as home ownership costs have doubled, making an unfavorable time for potential buyers. The accessibility of housing has hit a historical low of 37 years, dissuading potential purchasers from entering the market. The scarcity of available properties coupled with inflated valuations contributes to a sense of skepticism, as residences that were once acquired for $275,000 are now being listed at $500,000, eroding their perceived value. Despite positive economic data, skepticism about the housing market among Americans persists, possibly due to media-sourced doubts. Favorable factors like economic growth, low inflation, and unemployment impact personal outlooks only when experienced directly. So, are we navigating a sustainable path or heading toward financial instability? Are low interest rates masking potential risk? Share your thoughts below and keep the conversation going. If you found this discussion valuable, don't forget to like, subscribe, and hit that notification bell to stay updated on the more thought-provoking financial content. Thanks for watching.